What if the tax benefits that have driven property investing for decades were no longer available? With the latest federal budget reforms, Australia's investment landscape is undergoing a significant transformation. Changes to capital gain tax, negative gearing, trust taxation, and SMSF property investing are forcing investors to rethink long-standing strategies. The real question is, are you adapting your strategy to the new environment? Hi, my name is Helen Nan. I'm a certified finance planner and author of a finance book. The information I'm sharing today is general advice only, not personal advice. So please make sure you read the full disclaimer below. In today's video, I'm going to show you how these changes may impact investors. Real-world examples showing where new tax-effective opportunities may emerge. Let's begin with the biggest changes that investors need to understand. Capital gains tax is changing. Currently, if you hold investments for more than 12 months, you are generally entitled to 50% capital gains tax discounts. These rules are expected to remain in place until 30th June 2027. However, from the 1st of July 2027, the proposal is that the 50% discount will be replaced with an indexation method, and the minimum capital gains tax rates of 30% will apply. Let me show you an example. Imagine James buys a property for $800,000 and later sells it for $1 million after holding it for 18 months. Under the current rules, his capital gain is $200,000. Because of the 50% discounts, only $100,000 becomes taxable. If James is on highest marginal tax rates of 47%, his tax bill would be approximately $47,000. Now, let's look at the proposed new rules. There is no 50% capital gains tax discount. Assuming inflation is 5% over that period, indexation reduces the gain by around $10,000. Let's leave the taxable gain of $190,000. At a 47% tax rate, James would pay approximately $89,300 in tax. That's nearly double the tax liability. For investors who rely heavily on capital growth, this could have a significant impact on after-tax returns. Negative gearing is being removed. The second major change is negative gearing. Under the current rule, if your investment property makes a loss, that loss can generally be used to reduce your taxable income. This has been one of the key tax advantages of residential property investing. However, from 1st of July 2027, losses from established property purchased after 12th of May 2026 may no longer be able to reduce your other assessable income. What does this mean in practical terms? This means there's no longer an immediate tax benefits from making a loss on an investment property. Investors will need to focus much more on cash flow and sustainability. In other words, investment need to stand on their own 2 feet. Now, there are some important exceptions. Properties purchased before 12th of May 2026 may be protected under the grandfathering rules. Certain newly constructed properties may also continue to qualify. And it's important to note that losses aren't disappearing completely. They can still potentially be offset against future rental income, offset against future capital gains, or carried forward for future use. So negative gearing isn't completely gone, but its value as an annual tax strategy may be significantly reduced. SMSF property laws are tightening. The third area of change involved self-managed super funds or SMSFs. Under the proposed rules, SMSF borrowing will be restricted from buying residential property unless it qualifies as a business real property. For many investors, this removes a strategy that has traditionally been used to build property portfolios through superannuation. The impact could include less flexibility in SMSF investment decisions, and a greater need to consider alternative investment within superannuation. For some investors, this may prompt a complete review of their long-term retirement strategy. Family trust tax changes. The first major change relates to family trust. Trust distributions are proposed to face a minimum effective tax rate of 30%. Historically, many families have used trust to distribute income among family members in lower tax brackets. The proposed changes significantly reduce that flexibility. This means income splitting opportunities become more limited, and there may be less ability to distribute income in a tax-effective way across family members. So, many business owners and investors, this could change how trust fit into their overall wealth strategy. So, what does all of this mean? Let's simplify it. The old investment playbook often looked like this: buy property for tax benefits, use trust for income splitting, and rely heavily on tax concessions to improve overall positions. But under the proposed rules, the landscape is changing. Property may need to stand on its own merits as an investment. The focus shifts from tax-driven decisions to genuine investment performance. But there are still opportunities. Now, here's the good news. Although the rules are changing, opportunities still exist. In fact, history shows that every major tax change creates both challenges and opportunities. For example, indexation may outperform the old capital gain tax discount for investors who hold assets over the very long term, particularly in periods of higher inflation. Negative gearing isn't disappearing completely. Losses may still be used against future rental income or future capital gains. And some investors may remain protected, including existing property owners, buyers of eligible new build properties, and certain individuals receiving income support, such as age pensioner, where minimum 30% capital gains tax rules may not apply. The key is understanding where the opportunities are moving. So, where are the new opportunities? Many investors are now paying close attention to two areas: superannuation and insurance bonds. Why? Because both can provide greater tax control, long-term certainty, and potentially more predictable after-tax outcomes. Let's look at some examples. Let's imagine David is 50 years old and invests $400,000 into superannuation. If his investment earns 8% per year, that's $32,000 in earnings. During the accumulation phase, super earnings are generally taxed at 15%. That means around $3,600 of tax, leaving David with approximately $28,400 after tax. Now let's fast forward to retirement. Once David is over 60 and meeting the relevant super pension requirements, those same earnings may be received tax-free in pension phase. The investment still earns $32,000, but this time there's no tax payable. The key takeaway? Superannuation becomes one of the most tax-effective investment environments available, particularly during retirement. Now look at the insurance bonds. Imagine Emma, a 35 years old high-income earner professional who invests $200,000 into an insurance bond. Over 10 years, her investment grows to $500,000. That's a gain of $300,000. During those 10 years, earnings are taxed within bond at rates up to 30%. Importantly, Emma doesn't pay personal tax on those earnings each year. After holding the bond for 10 years, she can generally withdraw the fund tax-free. That means no personal capital gain tax on the $300,000 gain. no additional personal tax, and no annual tax reporting requirements on those earnings. Compare that with investing personally. Investment income could be taxed at rates up to 45% plus 2% Medicare levy, and capital gains may face considerably higher tax under the proposed rules. The key takeaway: insurance bond can provide tax certainty, simplicity, and potentially tax-free outcomes after 10 years. So it's a big shift. The old playbook was often property as a tax strategy, trust for income splitting. The new strategy may be understanding the new rules, using tax-efficient structures, and adapting to a changing environment. For many investors, that means taking a close look at superannuation and insurance bonds, both of which may play a much larger role in long-term wealth planning going forward. The rules are changing, but the opportunities still exist. The investors who succeed aren't necessarily the ones who resist the change. They are the ones who adapt to it. The question isn't whether the investment landscape is changing. The question is whether your strategy is changing with it. If you'd like to help understanding how these changes may affect your own situation, feel free to get in touch. And if you found this video helpful, please like, subscribe, and share it with anyone who may benefit from understanding these important changes. Thank you for watching. To learn more, visit compoundfreedom.eu, and I will see you in the next video.